Our today's topic of discussion is financial inclusion. The concept of financial inclusion, extending financial services to those who typically lack access, has been a goal for the government of India since 1950s. Nationalization of banks occurred in the mid 1950s to the late 1960s. Later on, there came lead bank scheme following nationalization in 1969 as a way to coordinate banks and credit institutions, because there was a need for a bank scheme which can coordinate banks and credit institutions by districts to more comprehensively ensure that rural areas had their credit needs met, because in the earlier banking sector reforms and even in the evolution of banking system, you all know that the rural areas were left unbanked. They did not have the facility of availing banking services. So lead bank scheme met the needs when it came after nationalization in 1969. It envisages assignment of lead roles to individual banks, both in public and private sector, for the districts allotted to them. So the districts are allotted to them, and in that particular district, the banks act as lead. So they are in charge of that particular area or locality. The lead bank acts as a leader for coordinating the efforts of all credit institutions in the allotted districts. In 1975, the Government of India followed this with efforts to specifically reach rural areas by establishing RRBs meant to exclusively meet demand in the rural economy, and the number of RRBs has significantly increased over the years. By the early 2000s, the term financial inclusion was being used in the Indian context. In 2004, Khan Commission, that is created by RBI, investigated the state of financial inclusion in India and laid out a series of recommendations. Now, when you include a term in your book, that is, I'm talking from the government's point of view, financial inclusion, you have a committee set up on it. You have to review it. You have to take measures so that you can measure it, whether the working of financial inclusion is beneficial or what is the rating, how is it working. So for that sake, Khan Commission has laid out a series of recommendations. In response, RBI Governor, that is Reddy Ji, expressed concern regarding the exclusion of millions from the formal financial system and urged banks to better align their existing practices with the objective of financial inclusion. And that was quite true. You must have such practices which meet the objective also. That is, if you are reading, there must be an execution of growth day by day. So you must have the practices which meet the objective too in both its annual and midterm policy statements. RBI has continued in its efforts in conjunction with the Government of India to develop banking products, craft new regulations, and advocate for financial inclusion. Moving ahead, we'll know financial inclusion strategies. Like, they have included the term in the dictionary, but what were the strategies through which they led the revolution? So very first is NFAs, that is no frill accounts, KYC, know your customer, business correspondence, unique credit cards like Kisan cards, electronic benefit transfer, that is EBT, self-help group linkage model, digital financial inclusion, and government policy strategies. We'll discuss them one by one. So in India, RBI initiated several measures to achieve greater financial inclusion. These rely on efforts of the financial sector. NFAs, also known as BSBDAs, can be opened with zero or minimal balances. BSBDAs stand for Basic Savings Bank Deposit Accounts. So here you can have either zero or minimal balance. It removes a cost barrier to banking because there is no cost involved. You don't have any money minimum balance to be kept in the accounts. Banks are also meant to charge minimal overdraft fees on NFAs to the minimum. BSBDA is a zero balance saving account that takes care of simple banking needs with free ATM card, monthly statement, and checkbook. So all the services available here free of cost. RBI continues to change and relax policies regarding these accounts in an effort to better serve bank customers. Expanding financial technology or fintech has been proposed as an effective strategy To achieve financial inclusion, incorporation of technology is used to deliver banking services to those in rural and remote areas who are typically unserved. The United Nations 2030 Agenda for Sustainable Development and the G20 High-Level Principles for Digital Financial Inclusion describes the importance of using fintech. Fintech is nothing but using financial technology where it helps us to reduce financial exclusion and income inequality, which means that the financial inclusion through fintech may show significant signs on the reduction of inequality and have the better growth. Because when you enable technology in an economy, automatically the developing nation term can change into developed nation because technology grows faster than the traditional methods. Banks have been advised to make effective use of information and communication technology so that the banks can provide services directly through the BC model, that is business correspondent model, where the accounts can be operated by even illiterate customers, that is illiterate customers, or by using biometrics. You can have the fingerprints, you can use your biometric, thus ensuring the security of transactions and enhancing confidence in the banking system. KYC, that is know your customer requirements for opening bank accounts, were relaxed for small accounts in August 2005, eliminating a documentation barrier to banking. The new procedure in KYC is now that you just require an introduction by an account holder who has been subjected to it. That is, whoever is subjected to KYC screening, you can just have an introduction. Additionally, banks were permitted to accept more easily produced forms of documentation for proof of identity and address. The BC model was launched in Jan 2006, where the RBI permitted banks to engage intermediaries in the banking process. This model enables banks to service neglected areas by allowing intermediaries to facilitate transactions and deliver other banking services directly. So all these models are basically based on the strategy of having financial inclusion in the remote areas, rural areas, or the areas and the citizens who are left unbanked or who are not availing the banking facility. So you can just relate the term, that is business correspondent and financial inclusion in the remote and rural area. So you have to just connect these two words. So in the remote and rural area, the financial inclusion strategy of business correspondent means here the business is facilitated using financial inclusion in that particular area. Originally, a fairly limited number of entities like NGOs and certain microfinance institutions were eligible to it, but however in 2010 the list was expanded to include profit companies as well. In 2018, operators of common service centers, that is CSCS, who work with local governing gram panchayats also began working as BCs to further improve penetration of banking services. Unique credit cards like GCCS, General Purpose Credit Cards and Kisan Credit Cards offer credit to those in rural and semi-urban areas, farmers and others with adjusted collateral security requirements with the objective of providing hassle-free credit. So at your fingertips without any much hustle and bustle, you can easily avail the credit. EBT, that is electronic fund benefit fund transfer, is being implemented by banks and the advice of the RBI with the goal of reducing dependence on cash, lowering transaction costs and address corruption. Increasing the number of rural banks remain a priority for the RBI. Self-help group linkage model has also been proposed to improve financial inclusion, which links community groups to the formal banking sector through government programs, credit cooperatives, NGOs, or other microfinance institutions. It is a group-based model in which members pool their savings and have also been seen as a tool for social and economic empowerment. It is particularly used by women, and using it, we came to know that women are leaders here. Digital financial inclusion. Now, financial inclusion using digital method. Technology-enabled innovations represent an opportunity to promote financial inclusion. Inclusive digital financial services refer to mobile money, online accounts, electronic payments, insurance, and credit combinations of them, and new financial technology apps. which can reach people who were formerly excluded. So here you're coming up with the apps and the services using which the people who were not having those facilities access can have it. For example, digital financial services can provide low-income households with access to affordable and convenient tools that can help increase their economic opportunities. Now, government policy strategies. So after implementing all these strategies, after having digital financial inclusion, what are the strategies using the policies of government are implemented? We'll know more about it. Very first is Manrega, that is Mahatma Gandhi National Rural Employment Guarantee Act. It's meant to provide supplemental employment at a guaranteed minimum wage and facilitate financial inclusion. Whenever you have minimum wage, you can have your bank accounts, you can deposit the money, and hereby at least you are included in the financial inclusion strategy to empower women and rural laborers. While achieving financial inclusion, it is not the main goal here. The program is directed towards depositing wages into bank account. As I said, once you have the income in your hand, you can open the bank account. So as a way to limit corruption, speedy delivery of benefits, and connect wage laborers to bank accounts. Next in line is Pradhan Mantri Jan Dhan Yojana. It is a policy scheme which provides universal access to banking through the creation of basic banking accounts that come with other basic financial services. On the inauguration day of the scheme, 1.5 crore bank accounts were opened, and since then, more than 18 million bank accounts have been created. In 2016, the Government of India instituted a sweeping demonetization policy in an attempt to stop corruption and the flow of black money, which forced people to deposit their money into banks, and thus digitalization in banking has its very first step, with the goal of integrating citizens into a cashless and taxable economy and banking system. Measuring financial inclusion. As I said, what are the measures using which you can measure the financial inclusion? Several organizations conduct surveys to measure indicators of financial inclusion and collect both supply and demand side data. MEX is one of the platforms which produces data-driven reports to track progress towards financial inclusion across the globe. That is, MIX is that particular platform. In 2013, Finance Minister of India P. Chidambaram launched the CRISIL Inclusix. It is an index which measures the status of financial inclusion in India. It is quite common, CRISIL, the rating system. India's leading credit rating and research company is collecting data from 666 districts in India and ranking on a scale from 0 to 100 based on 4 parameters of financial services. It publishes semi-frequent reports based on their findings with regional, state-wise, and district-wise assessments of financial inclusion. So today's questions are, very first is name any 5 financial inclusion strategies. Dash and dash describes the importance of using fintech to reduce financial inclusion and income inequality, which means that the financial inclusion through fintech may show significant signs in the reduction of inequality at the global level. Both these questions are quite easy. Go through the video once again and do answer these questions in the comment section, and stay tuned for more such videos.